Hey everyone, welcome back to another exclusive podcast from IronFX, where we're dedicated to bringing you the absolute best education to help you take your trading to the next level. I'm your host, Desmond, and today we're tackling an intriguing phenomenon. European stocks are at odds with the economy. Despite economic struggles in key European countries, major indices like the Euro Stoxx 50, DAX, and FTSE 100 are trading at or near all-time highs. What's driving this disconnect between the markets and the economy, and where might this divergence lead? Let's unpack the story. Let's start with the numbers. European indices, including the Euro Stoxx 50, Germany's DAX, and the UK's FTSE 100 are either trading at or near all-time highs. Right, over the past year, we've seen Euro Stoxx 50, driven by gains in heavyweight sectors like luxury goods, energy, and technology. DAX, a robust performance led by export-heavy industries despite weak domestic demand. FTSE 100 buoyed by a strong showing from multinational corporations, especially those in energy, mining, and financials. The share prices of many companies in these indices have seen significant gains, reflecting strong earnings growth, resilient corporate strategies, and global demand for European exports. Now, let's shift gears and look at the underlying economies. While stock markets are soaring, the economies of many European countries are struggling. Germany, the so-called engine of Europe, is grappling with sluggish industrial production, weak exports, and an ongoing energy crisis. Right, France, slower growth, high inflation, and labor market challenges are weighing on the French economy. United Kingdom, Brexit-related trade disruptions, high energy prices, and a cost of living crisis have led to stagnation in the UK economy. Economic indicators, including GDP growth, consumer confidence, and business investment, paint a starkly different picture from the bullish sentiment in European equity markets. So why are European indices outperforming even as the economies behind them falter? Here are a few key reasons. Global revenue streams. Many companies listed on European indices derive a significant portion of their revenue from outside Europe. For example, luxury brands in the Euro Stoxx 50 benefit from strong demand in markets like the US and China, insulating them from domestic economic weakness. Right, sector composition. Indices like the FTSE 100 are heavily weighted toward energy, commodities, and multinational companies that are less reliant on the local economy. Strong oil and commodity prices have boosted these sectors. Central bank policy. The European Central Bank has begun to loosen monetary policy, which has supported stock valuations. Meanwhile, falling bond yields in some European markets have made equities more attractive to investors. Corporate resilience. Many European companies have successfully cut costs, improved efficiency, and diversified their supply chains, enabling them to perform well even in challenging economic conditions. This disconnect highlights how stock markets often reflect global business conditions rather than local economic realities. The big question is, will this divergence grow wider, or will we see some sort of mean reversion? Here is the case for divergence growing wider. 1. If global demand for European exports remains strong, particularly in sectors like luxury goods, energy, and technology, stock markets could continue to rise. 2. Central banks may continue to increase the pace of interest rate cuts, further supporting equity valuations. And here is the case for mean reversion. 1. Prolonged economic struggles in Europe could eventually weigh on corporate earnings, leading to a correction in stock prices. 2. If global growth slows, European companies reliant on exports may face headwinds, narrowing the gap between markets and the economy. The path forward will likely depend on macroeconomic developments, corporate earnings, and central bank policies in the coming months. And that wraps up our episode on European stocks are at odds with the economy. While the disconnect between European indices and their respective economies is striking, right? It underscores the complex interplay between local economic conditions and global market dynamics. Right? Thanks for tuning in. And in the meantime, do remember to subscribe to our podcast here at IronFX, where we're dedicated to bringing you the very best education to take your trading to the next level. Until then, stay informed and stay tuned.